Do other countries have a negative gearing policy? If so, are they as controversial as in Australia? How does Australia's negative gearing policy compare to those of other major economies? In this video, we'll explore the approaches taken by New Zealand, the United States, Canada, and the UK, analyzing the similarities and differences with Australia's policy. By the end of this video, you will know where Australia's negative gearing policy stands, how other countries handle it, and what we can learn from them. Before we get into the comparisons, let's first understand what negative gearing actually is. Negative gearing is a term used to describe a situation where expenses associated with the asset are greater than the income earned from the asset. It can apply to any type of investment, not just housing. When it comes to rental properties, negative gearing happens when an investor's expenses like loan interest, maintenance, and management fees are higher than the rental income. In simple terms, it means taking a rental loss. Australia has one of the most generous tax treatments for negative gearing in the world. Let's see how it plays out in an example. John buys an investment property for $600,000, taking out a $480,000 loan. He rents it out for $650 per week, bringing in $33,800 a year. He has to cover a range of ongoing expenses, adding up to $38,000 a year. At this point, you can see John is paying $4,200 out of pocket each year to keep the property running. This rental property is clearly running at a loss and is negatively geared. But the loss John can claim doesn't stop here. There is something he doesn't even have to spend money on to claim: depreciation. He can claim deductions on capital works, which cover things like the building's structure such as wall, roof, and bricks. And he can claim on plant and equipment assets, which includes things like carpets, appliances, and air conditioning. Thanks to these deductions, his taxable loss grows to $15,200. John earns a high salary, $250,000 a year, so he is in the top tax bracket, paying 45% tax plus a 2% Medicare levy. This rental loss can be used to reduce his taxable income, saving him $7,144 in tax. Now let's do the cash flow math. Remember we said that John is paying $4,200 out of pocket each year to keep the property running? Well, now this tax refund has put him ahead by $2,944. So John's loss only exists in accounting terms. Three factors are transforming John's paper loss into a positive financial outcome. First, the generous depreciation claim. He can claim non-cash expenses like property wear and tear, increasing his taxable loss. Second, unlimited loss offset. He can use his entire rental loss to lower his taxable income, including salary. Third, high marginal tax rate. The higher his tax rate, the more valuable these deductions become. Now, if John has extra savings, do you think he is going to reduce his investment loan? No way, that would reduce his loss and cut into his tax benefits. He would rather be investing that money in his low-income spouse's name, or even better, his teenage son's name to get a better after-tax return. Meanwhile, he can sit back and wait for the property value to rise. With a vested interest in the property market, guess who he will vote for? The politicians who want to scrap negative gearing, or the ones who promise to keep it and push property prices even higher? Chances are he will buy more investment properties and repeat the whole process, stacking up even more tax benefits. What's not to love? That is the power or curse of Australia's negative gearing policy, depending on which side of the fence you fall on, investor or would-be first-home buyer. Now let's look at how other countries handle it, starting with our closest neighbor. New Zealand used to have negative gearing just like Australia, but in 2019 they made a big change, introducing ring fencing rules. It's like putting up a fence around rental losses. They stay trapped within the property portfolio and cannot spill over to reduce taxable income such as wages, salary, or business income. Instead, those rental losses can only be carried forward to offset future rental profits or property sale gains. Then in March 2021, under the Ardern government, New Zealand moved to phase out interest expense deductions on existing properties, with a full removal planned by April 2025. But in 2025, the new government reversed that decision, letting investors claim interest expenses again on both new and existing properties. Ring-fencing rules still apply though. So for New Zealand, it's a classic case of 2 steps forward, 1 step back. Compared to Australia, where investors can still offset their entire rental losses against other incomes such as salary, New Zealand's system makes property investing less attractive. The United States does allow negative gearing, but not every property investor can claim unlimited rental losses against their salary. Here's how it works. If you earn under $100,000 per year, you can deduct up to $25,000 in rental losses against your other income like your salary. But as your income increases, this deduction gradually phases out. Once you reach $150,000, you cannot deduct rental losses against your salary at all. Instead, those losses must be carried forward to offset future rental profits when the property starts making money, or used to offset capital gains when you eventually sell, much like the New Zealand ring-fencing rules. Now, there is a powerful strategy or a big loophole, depending how you see it: the real estate professional status. If an investor qualifies as a real estate professional, their rental losses are no longer passive losses, and they can deduct unlimited losses against their salary and other active income, just like in Australia. To qualify, individuals must meet strict IRS criteria such as time commitment, material participation, and proof of hours. We won't go into all the details in this video. It's not easy to qualify, but for those who know how to structure their finances, qualifying as a real estate professional remains a way to unlock unlimited deductions. So the US system at least tries to support lower income earners and does seem to have more guardrails in place. Now compare that to Australia. Here, everyone gets the same perks as a US real estate professional. Anyone can claim unlimited rental losses against their other income, such as wages, salary, or business income, regardless of your income, numbers of property, or profession. There is no special rule, it's just a given. In Canada, investors can deduct their rental losses against their salary or other income, no matter how much they earn or what they do for a living. That's similar to Australia. If your total income is already low, the rental loss can create a negative taxable income. In Canada, losses that exceed your total income can be carried back up to 3 years to offset past taxable income, resulting in a tax refund. You cannot do that in Australia. In Canada, if you cannot use the loss immediately, you can also carry it forward up to 20 years to offset future taxable income. In Australia, there is no such limit. You can carry forward indefinitely. At this point, many Aussies might think Canada is just as generous with negative gearing, if not more. But not so fast. Canadian rules are actually tighter in other areas. First, the Canada Revenue Agency, or CRA, Canada's version of the ATO, wants to make sure rental properties are legitimate businesses, not just tax write-offs. That means investors have to prove their property has a reasonable expectation of profit. If a property keeps making losses for years with no sign of turning a profit, the CRA can deny those deductions. In Australia, there is no such expectation or rule. Second, Canada's way to treat depreciation is far more restrictive than in Australia. In Canada, depreciation, called Capital Cost Allowance or CCA, cannot be used to create or increase a rental loss. It can only bring taxable rental income down to zero. Any unused amount can be carried forward indefinitely. While in Australia, investors can use depreciation to increase their rental losses and boost negative gearing benefits. The UK used to allow landlords to fully deduct mortgage interest from their rental income, just like in Australia. But in 2017, they changed the rules. Now, mortgage interest is no longer a deductible expense. Instead, landlords get a flat 20% tax credit on their mortgage interest. It works like Australia's tax offset, directly reducing the final tax bill. If Australia implemented this, anyone with a marginal tax rate of over 20% would lose out. Now, mortgage interest isn't the only cost of running a rental property. Other rental expenses such as property management fees, insurance, maintenance, council tax, and legal costs are still fully deductible in the UK. But unlike Australia, landlords in the UK cannot claim depreciation on buildings at all for residential properties. And here is the biggest difference from Australia. Even before 2017, UK rental losses cannot be used to offset salary or other non-rental income. If a landlord makes a rental loss, they have to carry it forward to offset future rental profits. That hasn't changed. So while the UK still offers some deductions, negative gearing as we know it in Australia doesn't exist. As you can see, many countries we often compare ourselves to have either restricted or abolished negative gearing, while Australia still has one of the most generous policies. From the example at the start of the video, it's clear that Australia's negative gearing policy has gone beyond the broadly accepted principle of offsetting investment losses against investment gains. Some argue that reforming or removing negative gearing policy isn't the real solution to the current housing affordability crisis, and the real issue is housing supply. There is a lot of merits in that, and many agree. But as a tax concession, negative gearing is a form of expenditure from the public purse, and now it's costing Australians billions of dollars each year. We should be asking who benefits, who pays, and what incentives it creates. Is Australia's negative gearing policy untouchable? Can Australia take some tips from these countries? What are your thoughts? Let me know in the comments below. Thanks for watching. I'll see you in the next one.